Welcome to this very special Growing the Future Productions live event. Is there a capital squeeze in agriculture? A Q&A with Canada's largest farmland owner, Robert Andjelic. Thanks so much for joining us. I'm Dan Eberhard. I'm your host, and it is my intention everyone at the table gets extreme value from this conversation. Today, Robert is going to share with you why he is concerned about where things are at, what he is currently thinking about the big picture, how agriculture is going to be affected, and where he believes you should be focusing now. But before we begin, I want to do a little bit of a housekeeping. The agenda today is that after Robert's 12-point thesis and his 3-point plan of what you should do, we will move into moderated questions, first with the sponsors and then with the broader audience. How am I looking and sounding? Panelists, can you give me a thumbs up? Am I doing okay here? Perfect.
You're good.
I'm good. Love it. Thank you. Now, we're over 400 folks in the call. Please put your questions and comments in the Q&A. Let me know you can see me, hear me. Emoticons are welcome. You can put your questions in the chat. I'll get to as many as I can. I had a lot of questions in the registrations, which I'm going to address long-term as well. Garnet Peter says, Dan is doing amazing, hearing you well. Thank you, Garnet. Look, Robert has graciously agreed to take any questions as long as it is respectful and constructive. That's chutzpah, folks. And we're not here today. It's not all about agreement, okay? Sponsors and participants may not agree with everything that Robert says, and we should caveat that this isn't necessarily financial advice, right? Legally. Is that a good thing to say, Robert?
Well, it's definitely not financial advice. It's something that I already did or am preparing to do. I just say what I'm doing, and everybody has to think for themselves and then analyze it for themselves and see if it fits them.
Well said. Thank you. And thank you for being so open. So, yeah, the goal is a thoughtful, productive conversation about what's going on in agriculture here. And yeah, put your comments into the chat. No problem. I'll get to as many as I can. We're going to go as long as the conversation remains productive and useful. Robert told me he's got like a 3-hour capability here, but we may take a bio break. He phoned me last night to say, if we need to take a bio break, we can do that. And the audience has the privilege of doing that at any time anonymously, but the panelists, not so much. But we are recording. The full recording is going to be made available inside the Growing the Future Mastermind. I'll put a link in the chat. You can go check it out on School, SKOOL. But you can also get the recording from any of the sponsors here today. And before we get to Robert, I just want to mention we got some great sponsors for this event. And also, I'm excited to share on the call today that Robert has committed to being at the Convergence Conference happening February 3rd to 5th in Regina. He's going to be taking questions from the main stage, and you can go to convergence.ag to rub shoulders with hundreds of like-minded folks in agriculture and talk to me, Robert. Shake his hand, look him in the eye, ask him what you want to ask him. We're approaching 500 on the call. So I just want to introduce very quickly our sponsors. I feel so blessed and honored that they would join us and support this conversation at the kitchen table as such. We are joined today by Janice Holscher, representing Scotiabank, a national leader in agricultural lending. She's got a little bit of renovation going on there. You might be hearing some hammering and banging outside of her window, but Janice, good morning. You're on mute there. Just wanted you to say hi. Wait for all the audience.
Thank you for that. Delighted to be here.
Thank you for your support. And this is the bank of choice of Eberhard Farms and huge sponsor of Convergence. So thank you very much. Ryan Hillstead from Core Wealth, providing strategic financial advice for farm families and entrepreneurs and a lot of ag background. Ryan, you're going to be at Convergence as well. Thank you for supporting this event.
Yeah, no, thanks for allowing me to be part of this. And I'm really looking forward to the great discussions that are going to come out of today.
Amen. No, that's absolutely true. We've just hit 500, folks. That's exciting. Tim Hammond of Hammond Realty, a Saskatchewan-based farmland advisor and broker bringing deep farm finance and land market expertise to expansion, transition, and acquisition decisions. You're going to be at Convergence as well. Thanks for coming, Tim.
Thanks for inviting me and allowing me to participate in this. I'm super excited about it. So thanks, Dan.
Oh, you're welcome. It's going to be great. Great perspectives on the call today. Ted Cockwell, an agricultural specialist with the Cockwell Group. His farm background, his commitment to always putting clients first has allowed him to become the top farmland realtor in the world within the RE/MAX organization. Thanks for joining us, Ted.
Yeah, thanks for having me, Dan. This is going to be an exciting call. I hope all of the producers and industry experts here walk away with some knowledge that's useful to them.
Absolutely, absolutely. And then this warms my heart. We got a father and son team. We know agriculture is very multi-generational, and this is good evidence. We got some realtors here working together. Harry and Justin Shepard of Shepard Realty Corp, a multi-generational farmland real estate team serving Saskatchewan and Manitoba. Good morning, gentlemen.
Good morning. Good morning. Good
Thanks
to
for
be here.
joining.
Thanks,
Awesome. You're welcome. Okay, folks. So we're going to get to Robert with no further ado, except put it in what you're thinking about, what you want context and clarity on, put it in the chat. Okay. Let's get warmed up here. This chat's going to be hot. What is it that you want to know from Robert? What do you want us to most cover? Okay. Use those digits, put it in there. We want this to be interactive, but we do want to get to Robert's initial thesis first. Okay. So we're just going to cover a lot of ground. This is going to be a little bit of an advanced course, but then we're going to make it very simple about what you should do. And the folks that are sponsoring this call are here because they're part of the solutions. So yeah, can you guys put it in the chat? Let's see it. Go ahead and put that in the chat. And then Robert, okay, we're going to get to, run through your summer here and everything. But when you called me a month ago, did you have any idea we would be here talking to 850 people registered, 500 people on the call? This has really struck a chord in the agriculture community. You're passionate about what you want to share, but you said you thought long and hard before you picked up the phone and you called me. Why did you decide, Robert, why did you decide to speak now?
Well, as you know, you asked quite a few times to go on the podcast, and I really didn't want to. I debated this one long and hard after my trip to Toronto, well, out east, meeting with, I guess about 20, 30 different lenders and getting their perspective where they're at. And I get the feeling that things are changing and changing very rapidly. Okay, and then I kind of weighed, well, should I go on your podcast and talk about it? Because I know I'm going to get a lot of criticism, and really there's no advantage, nothing for me in it, other than spread the word and maybe save a few farms from bankruptcy or foreclosure or whatever. So I thought to myself, well, geez, it's equated to I'm thinking a tsunami coming. Done my homework, and this is what my data shows. And I have friends out on the beach, and I have critics out there as well. I think the right thing to do is go out there and tell them the way I see it and what I see unfolding, and then it's up to them to take measures or do whatever they want.
You have a very unique perspective because not only have you studied history and long wave theory and macro cycles and economics, and you've put your money where your mouth is in some giant bets. Anybody listening to the original podcast knows that. But you've also got this perspective where you traveled to Toronto, you met with the regional heads of banks, credit unions, other lenders on behalf of the ag industry. You're always lobbying on behalf of agriculture. People may or may not know that, but what did you see out there? What were the conversations that you had out there in Toronto? So this is our first point, okay? Our number one of the 12 points. Tell us about your trip to Toronto, Robert, and the impact it had on you.
Well, after meeting with most of the lenders, I had seen a kind of common theme throughout there. Uh, Mostly that the fact that they are being pressured by non-performing loans, mostly to do with commercial real estate. Now they've been kicking the can down the road for 2, 3 years already, or even more. On what we in commercial real estate call extend and pretend. In other words, they're doing everything they can to make the loans doable that they're performing to some degree, extending the duration of the term, and then giving them breaks up front, lower payments, and so on, because the vacancies are quite high in commercial real estate. That, and then the fact that the banks are being overseen by the Office of the Superintendent for for financial institutions. And then after I seen all that, that's quite a bit different than from my previous trips. I've been going there, what, now 14 years,
Yeah.
lobbying on agriculture, trying to educate lenders about how different agriculture is from the rest of the commercial real estate or rest of the investments.
Yeah. And the OFSI, that's a point we're going to delve into a little bit more down the road here. But your number two, your takeaway was it's not that banks are hostile to agriculture, it's that banks themselves are under pressure from a different sector of the economy.
Yes, that's 100%. And that the pressure being coming mostly from commercial real estate.
Yeah. But your third point on your notes here was that you talk strongly about the necessity of credit and the role of banks. And you said something pretty visceral in the green room where 500 or 1,000 years ago, without banks, I mean, if you wanted something, you sort of just went and took it. Now you can lend money to get it. So civilization, society has changed. It's a lot more civil having a bank involved.
Well, I'm very thankful for the lenders throughout my life. I started with zero, okay, and so in the past, as you alluded to, you either had to be born into a rich family, go wars, pillaging, and so on, and that was the only way to get money. But with the help of the banks and the credit, they make it a lot easier and different. And I treat my lenders as partners.
A lot less William Wallace.
Well, whatever it is, without them, I wouldn't be able, or none of us,
Yeah.
all the audience, none of us would be able to do what we're doing today without the lenders. So that's why I wanted this podcast. I wanted to put the two together, and so they can work together down the road. And down the road, we're going to cover what these steps should be.
Yeah, it's funny because I was just reviewing how our grandfather was actually not that, didn't want to work for the banks and the machinery companies, but Harvey, our father, obviously has thought that this is an excellent tool managed properly, and that's the way the farm has got to where it is today. So absolutely a part of modern economies that's indispensable. So number 4, where are we in the economic cycle, Robert? You talked about we could have prepared more 2 or 3 years ago, but here we are.
Well, in your previous podcast, that one that you did, Growing the Future, 1, 2, 3, I covered all that. At that time, it was fairly easy to get ready for a serious downturn like what I feel we're facing now. Okay, we're in a long wave. That's about 80 years. We're at, I think 2025 was the 80-year mark, 2026. That means that economy is going to be in a very, very tough position. And from what I foresee down the road, most likely a worldwide recession. May be as bad, I'd say, in my view, it'll be worse than 1929.
Yeah, I thought you were going to say 2019 or maybe 2008. That was not on my bingo card that you were going to say 1929. So bigger than most.
Well, the problem today, we may cover this further down. The problem today is we have so many economically offside industries and like the shadow banking system, the derivative market, the commercial real estate market, consumer credit, sovereign debt. There's your 5 items, and there's most likely more if you want to break them down into more categories that have to be corrected. Trade, tariffs. Tariffs are actually part of the trade deal, and fact that an existing world power is being challenged by an up-and-coming power, China. Okay, but we can get into that later.
Juicy. I love it.
There's so many items. Before we got a recession, like even the 2008 was 1, 2, 3 items that had to be corrected. They weren't easy, but they were doable. But now you're talking 5, 6, or maybe more. But this is worldwide. This is usually before it was always one country that had the problems, like whether it be Argentina, Russia, or whichever one. But the rest of the world was doing not too bad, so they could pull it out. But now when the whole world's in the same boat, that's why I say this recession/depression could potentially rival 1929.
Sounds like a country song, and I guess our big toe is getting sore from kicking certain things down the road. But digging a little bit deeper in some of these specifics, you're using a lot of terms maybe not everybody's super familiar with. I've never heard of the OSFI. Sounds like very interesting. Sounds maybe like a CIA or FBI or something. But what does acronyms stand for? What is the OSFI?
Well, everybody thinks, the banks don't want to lend, or banks are being hard on this and that, and that's not the case. They're being governed by the Office of the Superintendent of the financial institutions. And so in other words, they're getting the same pressure that you might be getting if you're offside on your loan, or if your profit margins are being squeezed or whatever. So the whole my whole idea of this podcast was to maybe give the producers and the whole agriculture industry some insights as well, how to work with the banks and how to be proactive than reactive.
Yeah, no, that really makes sense. And then your 6th point was there is a shadow banking system at play here as well. And you might not deal with it directly, but.
Yeah, shadow banking is basically all institutions, not institutions, all lenders that are outside of the normal banking system that aren't governed by the Office of the Superintendent for Financial Services and so on. The rest are, like, the banks are covered, pension plan funds are covered under that, but the shadow banking system isn't. And that's something I think in the neighborhood of, I forget the numbers, but it's in the trillions.
Trillions, yeah.
They actually are, shadow banking system is actually larger than even the normal, within the framework of the 5 or 6 big banks.
Yep. Okay. Whew. Okay, we're at point number 7. Farmland/gold/silver versus real estate risk. Farmland, gold, silver, no counterparty risk versus real estate risk connected to currency crisis, sovereign debt crisis. Talk to me. Talk to me, Robert.
Well, again, going back to your podcast in over 2 years ago, a lot of people ask me, well, if you didn't have a chance to invest in farmland and you had to invest someplace else, where would it be? My choices was gold and silver, most likely the reverse, silver and gold, mainly because silver throughout history, like if you go back to Roman times, the normal ratio between silver and gold was about 12, 13, 14 to 1. It varies as it does today. Another was 12 ounces of silver will buy 1 ounce of gold. But this was skewed way out of line where it became almost 100 to 1. So that's the reason I say silver was my number one choice back then. And it still most likely is today going forward. Because as you can see, what gold is doing, it's performing really, really well. So those, but farmland correlates closely to gold. It doesn't correlate to the stock market. It isn't correlated to the stock market and so on, because at the time of problems and economic difficulties, people run to, and especially if there's a war coming, people run to gold, silver, farmland. Throughout the recessions in the past, always did reasonably well, as did agriculture. Why? I can go back to the Weimar Republic. Weimar Republic, they had inflation where it just was blown out of the water. You needed a wheelbarrow full of their currency to buy a loaf of bread. Okay, so what did people do? If you want some eggs from the farmer, the people would take the gold chain from the wife's gold chain, take a few links off. There's your few eggs. You want a chicken? Well, there's a few more links. But they were trading basically in gold, and the farmers did very well. Not very well, like relative to booming economies, but they did exceptionally well according to the rest of the industries and businesses.
Well, I just got a note from my trading guy there, Dwayne Sador, yesterday. He said a little bit of a red flag in the market. Copper is higher with gold and silver. That shouldn't be happening. That could be a flight to safety. Could see a commodity super cycle coming. Does that ring a bell? Does that resonate? Copper shouldn't be higher with?
Yeah, well, copper should be higher, definitely. But copper is correlated more or less to the economy. Okay, you have to have a good growing economy to use copper and silver to some degree as well, because it is an industrial metal as well.
Yep. Hey, point number 8. Yeah, go ahead.
Another thing about farmland, like everybody says now, well, the population may not grow from 8 billion to 9 billion, 10 billion, and so on.
Mm-hmm.
Okay, there's other factors that you have to consider as far as farmland is concerned. Annually, we lose between 10 to 12 million hectares. 10 to 12 million hectares, 10 times is about 25 million to 30 million acres.
Where's it going? Where's it going, Robert? That's a big number.
Well, that's wind erosion, urban expansion, desert creep, environmental issues,
climate change,
soil degradation, all kinds.
Climate change.
Yeah. So that being said, you're losing farmland, and so less can be grown. So it's like in commercial real estate or in real estate, you take out an X amount of buildings. Well, the people have to go someplace.
There's going to be a lot of questions, I think, about farmland values on the call today, and we'll continue to get to that. But number 8, USA currency debasement and key milestones. Bretton Woods, 1971. Nixon ends the gold convertibility. 79 to 82. Volcker tightening. Talk to me.
Well, the Bretton Woods agreement was the agreement to have the U.S. dollar as the main currency for all the commodities, oil included. Uh, and then so that's why the world needs U.S. dollars and has to trade. Everybody's talking about, oh, there's a alternative, the BRICS and so on, but they can't come close to the demand that it's out there for the U.S. dollar, mostly euro dollar. Euro dollars got nothing to do with European or anything. Euro dollars are simply dollars that are in circulation outside of the USA. Okay, and then when you talk to the Nixon era, 1971, when he took the gold peg to the dollar, US dollar, that was pegged at, I think, $35 per ounce for gold. But of course, US was running such huge deficits because of the, I think, North Korean war at that time, that it had to do that because it was blowing their deficits out of the water already, even back then. So the only way was to disconnect it, because at that time France wanted their gold back, because at that time US was holding all the gold for most of the world. So that once they started converting the gold, their bonds and treasury bills, U.S. bonds, treasury bills to the gold, and they wanted their gold back. Of course, there wasn't enough gold because the deficit was taking over.
Yeah, you had mentioned gold was going to go to $5,000 to me at one point, which seemed like a faraway destination, but here we are. Here we are. Number 9, today's economics problems in brackets. You got the list. You've got sovereign debt. You got consumer debt. We got some consumer debt out there. Rollover risk, trade fragmentation, shadow banking, commercial real estate, derivatives. The expansion of derivatives is 25% higher since 2008. Think about that. Where we were in 2008, now we're 25% larger on the trillion.
2008, the derivative market was big and caused all those problems. Now, if we're about we're 1.5, I think, times larger today.
Yeah.
Now, how are we safe today?
800 and some trillion. Yeah.
Yeah. Now, why am I talking about all these different investment vehicles? That's all they are. They're just investment vehicles and financial tools. But the whole economy is interconnected like this. And you may not be participating in the derivatives and the shadow banking and all the rest, but you're affected by it every day. Mainly because through your exposure to these what's the word for it? I'm looking for is
instruments or
party risk.
Mm-hmm.
Yeah, that comes along with it.
Right.
But the whole world is interconnected like this. That's why now you pull a string here in Canada that resonates out in China, India, all around the world.
Yeah.
As I say, this recession is not going to be easily solved. And the further we kick the can down the road, the longer it's going to take us to get out of that. And the deeper it's going to be and last longer.
Number 10 is a real doozy. And a lot of these things I've heard quite a bit over and over from you, but this one, I don't know. I'm really curious. The European Union breakup, subsidy removal, you believe EU fragmentation is likely within a few years if subsidies fail. Ag commodities compete on yield, not policy. North American producers improve relative position. Trade distortions lessen. That's good for us?
Well, it's good in a way that I don't see you lasting 2-3 years. NATO's going to go first, US going to pull out, then I don't see EU lasting much longer past that. Mainly like Germany's been in recession, what, 2-3 years now?
Mm-hmm.
And there's not much you can do with it if you don't have the natural gas and or the oil to power your industries. So I see a lot of turmoil with the different countries of the EU and ultimately breakup. But EU is a very heavy subsidizer of agricultural commodities and a lot of other subsidies that we're not even aware of. Like let's say in Germany, where they participate 50%. When you buy a new combine, $1 million, they give you 50% credit. You get as a right. That's a subsidy in itself. It doesn't have to be direct for grains or for whatever. So after the breakup, I see those subsidies going away, and us as pure producers, big and very efficient producers, may add, will benefit from that because we'll be competing on a much more level playing field.
Still kind of nice if you got one passport, you can go from Greece to wherever and get a meal. But nonetheless,
you can make your money in Canada or US.
Hey, where's your favorite? What's your favorite European country to get a meal in, Robert?
Oh, I never went back.
You never went back?
Absolutely no.
Oh,
So we gotta look at it. Canada gave me everything that I got, and I love the country. Every province has something to offer, from Nova Scotia all the way to BC. Why? What do you want to go anywhere else?
Well, I was kind of thinking, you're a guy who could go wherever you want, but here you are. It's probably minus 15 outside and in the prairies, and you're on a webinar talking about this stuff. You could have been on a boat in the Mediterranean or something, probably being served, but it's up to you. Number 11, the U.S. banking crisis. You said there's around 1,800 banks with real estate exposure exceeding 300% of equity. This is reinforcing your core warning that there's stress in the banking system, especially outside of agriculture.
Well, the world economy basically will go the way U.S. goes, okay? And again, U.S. is invested everywhere, and they may seem like they're foreign companies, but they're really U.S. owned, or you own the U.S. stock market or whatever you like. Yeah, there's 1,700 and some U.S. exceeding 300% of their equity. So they got far more outstanding loans outstanding than what their equity can ever cover. That's the regional bank. Regional banks in U.S. Are the major players in the commercial real estate. Some of those regional banks have as much as 70% of their book value in commercial real estate. So my point is those banks go as commercial real estate goes. And if you're talking 50, 60, 70% vacancy, that is the problem. They can't meet their mortgage commitments, and worse yet, refi coming up. I think in Canada, but there's $1 trillion or more in refinancing coming up in 2026. And then you're talking rates of 5 years ago normally, because we were 5-year terms usually. So that mortgage was agreed to 5 years ago, usually around 2-3% or whatever. Today it'll be almost double.
Yeah.
So you're talking residential, you're talking commercial, you're talking. I'd like to set one thing straight. There's no finger pointing here. The banks are to blame, or the consumers to blame, commercial real estate to blame. We're all to blame. We all had a big advantage, and doesn't matter whether it was your employment or you making sales, more sales in your business, or whatever. We all participated. Like it was as much fun as when you got your new credit card and you got a $10,000 or $100,000 limit spending. Now it comes due. It's time to pay the piper.
You're talking directly to me right now, Robert. You're speaking to me. You're speaking to me very directly now, Robert. I feel like I'm kind of the only person in the room, and I'm listening to my dad actually, who's on the call. But yeah, no, I hear you, man. I hear you, and I take personal responsibility as well, for sure. So definitely.
No, but that's what I'm just trying to set the record straight that this is not all these economic problems are because of the excesses, and we all participated. Some to a much larger degree than others, but bottom line, we all benefited to some degree.
Yep. I'm getting some messages from folks that are trying to get into the room. It looks like we were capped at 500. Unfortunately, I will follow up with those folks that couldn't stay on the call or got, it was over capacity. So, but your 12th point here, and I'm going to review them all quickly when we're done, is essentially that ag is different. And then we're going to present some solutions because we don't want this to be a glasses half empty call. But you're saying ag is different, especially because of the year-to-year reset.
Well, okay, when you look at our entire economy, the lenders, we're going to look at it. Yeah, we got problems here, this and that. The more problems they have and the more offside loans they have, the more they're hammered by the regulators to control that. And but those like commercial real estate and all the rest, they're not going to correct anytime soon. They're going to correct maybe 5-10 years down the road. But agriculture is different. Agriculture doesn't depend on the stock market, as you got non-discretionary spending. You can postpone a car payment or car purchase, year, 2 years down the road, just fix your old one, but you're not going to postpone food. Okay, you have to put food on the table.
Yeah.
That being said, then on the other aspect of global trade and global yields, it's governed year by year. If your big trading part or trading competitor, let's say Australia, has drought or whatever, and the yields are way down, somebody has to make up for that. Prices will go up, the supply and demand issue. So that's why agriculture is, again, very different from commercial real estate or any other type of investment.
Robert, I don't even want to postpone lunch. Do you know what, like when you talk about food, I don't even want to skip a meal. So you're right. It's very important. And that's the business that we're in ultimately.
Well, that's why the agriculture and performs much better than any other industry, regardless of the downturn. You can go back 4 or 5 past recessions, and you'll see, yes, we will pull back, mainly because of capital restraints and not as much capital going into agriculture. But it's not the demand. The demand for ag land is right up there. It just, if it requires twice as much money to buy, twice as much deposit or your participation, loan to value 50%, it'll be that much. You can buy that much less.
Oh, we've had a little bit of inflation, haven't we, folks? I'm feeling it too. Well, let's do a recap on your 12 points of your thesis, Robert. We'll give you just a little break there. And you did fantastic, by the way. Thank you. That was a great overview. I mean, this could be a 6-hour masterclass, and maybe it should be. I've been begging you to do more, but You said that you just want to get your message out and you get a business to run. So we appreciate you taking time. But I'm going to recap the 12 points here, and then we're going to do a quick 3 points of what you can actually do about all this. We don't want to be sitting here helpless. There's plenty we can do on planet Earth, given our ingenuity and our capital and our intellect and our work ethic on the prairies. So, and then we'll hear from the sponsors' questions, and I've got lots of questions in the chat. So we're 40 minutes into it. I think we're doing pretty good here. I'm just going to recap. I had a request to recap the 12 points here, and absolutely we'll get people more structured output from this, transcripts, summaries. We'll be exploring more of this in the mastermind, and you can contact the sponsors about it as well. So number one, we started with Robert's high-level trip to Toronto to meet with all kinds of different folks in the lending industry. And then number two, his key takeaway was that things are a little bit different this time in the conversations, and it's not that banks are hostile to agriculture. It's just that there's some changes going on that we should be aware of, and we should be addressing and conducting ourselves accordingly. And again, point number three, Robert's been stressing all along the necessity of credit, and the role of banks is indispensable unless we're, living in villages and running around taking what we want. And we've sort of progressed from there. Thank the Lord. So let's keep civilization rolling here. Where we are in the economic cycle, he's arguing that you missed the time frame to prepare in almost ideal conditions, but there's still things that you can do, which we're going to cover here shortly. He talked about OSFI, the Office of the Superintendent of Financial Institutions, which was a great education. I was not aware of that. And a little bit on the shadow banking system was the 6th point. And that was really interesting. And number 7, farmland, gold and silver versus real estate risk. That was a great discussion. Number 8, the USA currency debasement and key milestones. Getting a little bit of education there. And 9, today's economic problems. The list goes on. It's all interconnected, and pull on the string and your sweater starts to unravel, as he put it. 10 was the EU breakup. That was a big one. That's very interesting. Lots of folks will be chewing on that. And number 11, the U.S. banking crisis. And number 12, ag is different. So, I mean, hopefully everybody got their money's worth with a little edutainment there. And we could go into a lot of it, and the questions are coming hard and fast. But we have a 3-point plan. We want to simplify this because it's very simple but extremely important to do, and maybe not easy.